Morning, Mr. K.
Yeah, good morning, Eric.
Today our topic is about economies 101. And many years ago, when I was still studying in secondary school, I remember one of my friends. He actually asked me the questions, which is our today's topic,
Mm.
and I have no idea. The, the question is, where does the money go in a recession? Mm, or in maybe a financial depression? So this question is so hard for me at the time, and I have no idea. And I thought, uh, I have a few answers,
Mm.
but actually didn't verify it. I also didn't validate my my answer, my thoughts at the times. Only after I learned so much the economy and macro, and I start to realize that I'm able to answer this question. So at that time, my thought is like, yeah, the money seems like cannot be disappeared. So it must go to some people pocket.
Mm.
But how they earn money? Yeah, how they earn money from us? Mm. And my my reasoning is just stop at here at the times because I don't know how the stock market function. I don't know how the bond market function. I don't know how government, how central bank functions, how they how their behavior, how their action can affect the market. Yeah, so yes, so fast forward to today,
Mm.
we discuss this topic. What is your thoughts?
Okay, for me, I think this is still a question that I couldn't solve until today. So I think yeah, I can learn something from your understanding. So my thoughts is the money uh, is stay in the bank and also stay with consumer, which is their saving or investment, as well as for bank also the same. They
Mhm.
keep it or they invest in somewhere else.
Mm.
Yeah.
It means, yeah, so that's all.
Yeah, the spending is reduced. The money from consumer previously is supposed to be spent to the market. For example, they do the spending, they go on holiday, they buy house, they buy something, they buy many things. But
Mm.
in a recession, they reduce all this kind of spending. They save it. They some of them invest it. Yeah, this is for the consumer side. Yeah, and for the bank, yeah, I think for the bank they find it hard uh, to to lend money, which is the maybe the demand for borrowing money reduce, and people as well as company they reduce borrowing. Yeah, they
Mm.
didn't borrow so much, and bank has got the kind of like the excessive supply of money on the hand, and then they will invest to reduce the opportunity cost. So they will invest, I think.
Mm. Yeah, I think maybe I didn't use the terms properly. What actually means for this topic is where does the money go in a financial crisis? Yeah.
Yeah. So you mean who hold the money right, at the end?
Yeah, it means yeah. Where does the money go to? Because
Mm.
mm, yeah. So mm, okay, the first thing is, do you think people like the first thing is whether this money is go to some people's pockets, right?
Yeah, it must be. It must be one party has got this has got the money.
Mm.
Mm.
So okay, you see, like in 2020 March, and the stock market crashed, right?
Yeah.
And crashed very, very hard, like around maybe 40% to 50%.
Mm.
And compared to the top and the bottoms, the market caps lost about half, right?
Yeah.
Yeah. And also all the property, maybe the value get affected. And yeah, you can assuming, let's say the value dropped around 30%, 40%, and the whole real estate, the property market, including the commercial property and residential property, is around 200 trillion around the world. So you see, if it dropped around 30%, 30% of 200 trillion gone, but goes to whose pocket? If you think it must be goes to some people's pocket.
Mm. Okay. If you say the price of something price drop. Yeah, to me it is like disappear. The value of the asset drop, and people they lost money. So I think it kind of like disappear. I
Yeah.
don't.
Yeah. So where the money goes? Just when disappear? Okay, try to imagine. Not imagine. It's a real. You make an investment maybe 1 year ago.
Okay.
But fast forward today, you see that your portfolio dropped around 30%. Where does money go to?
Drops, but I still keep it. I still keep the stock. I didn't sell. Yeah, I really couldn't figure out.
Then why the market drop? Why the market will rise? When the market rise, where the money come from?
Market rise. This is to me. It is just like the bubble. It is like the expectation of price by the market. So I think the money. There is not the equal amount of money and all these kind of assets, which means, let's say we have assets 100 worth 100, and the money on the market doesn't necessarily worth 100.
For example,
yeah, let's say you use 50 to buy the asset, and the price of your asset rise to 100. Yeah, but
what's the price of the asset?
100. So
100.
rise 50 to 100.
So how much I invest?
50. You buy 50 and it
Oh, okay.
rise and become 100.
So just what you mean is the price double.
Yeah, the price double. But the money that you pay is only 50.
Mm-hmm.
Yeah,
So
I
I earn money, I make money, right?
yeah, but
But where the money come from?
yeah.
Mm. Are you talking about the money is not real? But you
Yes,
can
something like that.
but you can
If you
sell the
don't sell
stock.
it,
But you can sell the stock. You can get the real money. You
yeah,
can hold the real money. Yeah. If you want to say the money is not real, but it's real, you can directly convert to cash, right?
yes. If you can find a seller, of course you you can find a buyer. Of course you can get the money.
Mm.
Yeah. So the money is from the buyer.
But you didn't sell the stock.
Yeah, I
Nobody
got it.
pay
So
you.
this is
Yeah.
why I think they are not real. They are just the
But
number.
it's but why is it not real? It can be real because people recognize it, and you can sell to the market, and you can get back your real money. You can quit the game anytime you want, and people willing to pay the price to buy the stock. How come it's not real? Where the money come from?
Mm, yeah, I can't understand. I can't figure it out.
Yeah. So the question is why? Why the market will go up? Why your stock price will go up?
Okay. This is demand from the buyer.
Why they demand? Why they demand the stock? The stock cannot be eaten. The stock cannot provide cannot support their survival. Why they want to pay money to buy something that cannot be eaten?
Okay. Cannot be eaten, but it will give return. Yeah.
So why they want the returns?
Yeah, it returns to increase their wealth, right? We can.
So they can make money, and then they
Yeah.
can buy something they want. They can buy the
Yes.
boots. They can buy the house to
Mm,
support their living.
yeah.
And why everyone think the same? If there's only you believe in a coin, maybe it's a coin. I'm not specifically mentions the crypto. It could be any coin. It could be a country currency.
Okay.
It could be a money. It could be a coin you created by your own, right? A or a stock or your company. You establish a company. You hold the equity, right? But nobody recognize the value of your company. Nobody recognize your coin, how much it worth.
0.
But when there are some people value your company, stock or your coin, how much value it will have.
Okay. It was the money that they're willing to pay for that.
So now try to imagine you have 100 coin. Initially, nobody value them, so it's 0. Yeah, no matter what number times 0 equal 0. Now there's one people willing to pay $1 to buy one of your coin. So how much your total coin, how much the total value of your total coin now?
Okay, because that guy is only willing to buy one, so which means the other still worth 0, so it's 1.
But is the function, but is the market function like this? For example, you sell me stock.
Yeah.
People willing to pay let's say $30 to buy the stock. The next day you see people willing to pay $40 to buy the stock. How much the market caps rise? What is the formula of market capitalization?
40 minus 30.
I mean the formula of market capitalization.
Formula. Formula is the number of stock times the current
number
market
of shares.
price.
Yeah, number of shares.
Yeah.
The number of shares times the market price. So the total number of shares is a constant, at least in the short terms, right?
Yeah.
So it's fixed, but it changes the price, the market price. So when the market price, let's say double from 1 to 2, or maybe from 5 to 10, the market capitalization times also double, right? So how much value of the company is a market capitalization, right? People always use a market capitalization justify the value of a company. For example, this is a 300 billion company.
Yeah.
What does it mean? It means that there are people willing to pay 300 billion to buy the company. Now, if there's another person willing to pay 1 trillion to buy the company, how much the company worth?
Yeah, according to the price.
Yeah, 1 trillion.
They're willing to pay. Yeah.
But this is buying the whole company. How about you buying a share, just a share? One share, you move the market up, you move the price up, right? And you also can move the price down. Of course, there's no one or no entity or no company are able to move a very, very big stock because the liquidity is so huge. Do you understand what I'm saying?
Liquidity is so huge. What does this mean?
So for example, your coin. Now you have 100 coin, right? I can simply move the coin to a trillion market capitalization. You also can do that by your own. How to do that? Make it worth more than a Bitcoin capitalization. How do you do that?
Yeah, but I need to find someone who is willing to buy, right?
Yeah, you give them money and ask them buy. You give your girlfriend's money and ask your girlfriend buy a stock. Couldn't you do by your own?
But you need to have that money, right? That much of money.
How much money you need to boost your coin to a 1 trillion market capitalization?
Wow.
Simple mathematics.
1 trillion.
No. You see the market capitalization, what's the formula of market capitalization?
Oh, I see. So it has to be divided by 100.
So you need a lot of money, right?
Yes.
But how about when your number of share or number of coin is, let's say, make it easy, 100 billion. How much money you need to boost your market capitalization of your coin to 1 trillion market cap?
$10.
You just need $10. I mean, this is just buy one coin. You can buy 0.01 coin, you know, in order to boost the market capitalization. So let's say now your total number of coin is still 100. How do you boost your coin, the market capitalization to 1 trillion market caps? By using $10.
$10. Oh, can I increase the number of coins?
You cannot increase the number of coins.
Cannot increase.
What if you can buy 0.000000001 of coin?
Oh,
it can change the price, right?
Yes.
And it's how the crypto market works, right? There's so many decimal points. There's so many decimal points. And but of course, the number of shares is also huge. It's so huge. So a simply double of the price, because their base is huge, which is their total number of shares is huge. So the market capitalization double, triple. It can go up so easily, double, triple, by a factor of 10, by a factor of 100, by a factor of 1,000. It's very simple. But what if you want to move a 500 billion worth of coin? I mean, listed on market, or everyone can trade it. Everyone can trade it, not only manipulated by you, only you. It will be very difficult. So because there is a liquidity, the liquidity is huge. Many people participants in this game. You can move the price up, but if somebody think that the price is not worth that, they will sell. And then you pay above the market. You pay above the quote unquote the market price, which justified by all the market participants. What if you want to make and also if your coin liquidity is low, there's no many buyer. There's no many buyer to beat the price. And also there's I think it's bid or ask the price. And also there's not many seller bid and ask the price. So that means that you want to move the market, you will be very easy. You'll feel very easy to manipulate the market, to move the markets. You can use a little money, very little money, to move the market. But what if there's a lot of people willing to pay the real money because they bid or they ask the price slightly below the current market price, right? This is how you see the logbook. So how much money you need to move the Bitcoin price go up by a factor of 10, make it drop of 10%? You need quite a lot of money because the liquidity is huge. How about if you need to do the same thing on let's say an altcoin, which is your coin, Mr. K coin? You just need very little money, right? Now you got it. So come back to the question, where does the money go? when the market up or when the market down?
Is it going to the person who hold the share, who hold the asset.
How do you think? Why is this? It should be like that? Give me some of your reasoning.
Yeah, I think I still couldn't get the key or the logic behind this. It is still.
Yeah, I mean, try to link together.
Mm.
Because you really have to think. You really have to start to figure out so that you can understand, right?
Yeah.
You don't need to be afraid mistake.
Okay, let's say stock. Okay, if I hold a stock, which I previously buy, let's say 100, and today's, let's say, more and more people come in and buy this stock, so the price of the stock and as well as the market cap increase, so everybody get the return from the increasement, right?
I mean the holder, right? The shareholder,
Yeah,
or the
every holder.
investor.
Yeah.
To make the terms more specific, is the existing shareholder or existing investor gain, not the incoming investor who pay a higher price.
Yeah. Yeah.
Which, because they move the market.
Yep.
Yeah. So your money, but does your money come from them? I mean your wealth, the money you make come from them?
It's caused by them but not come from them.
Why?
Okay, let's say the price go from 50 to 100, then I think it doesn't mean that the person who want to push the price need to pay 50 times the total number of shares.
Which is which is the increments of the total market capitalization, right?
Yeah.
They just need to pay a fraction.
Yep.
And it depends on what? It depends on what? It depends on the liquidities, right?
Yeah.
Yeah. So yeah. So you have linked everything together. Yeah. Is it not difficult, right? And so you see, when a seller or the buyer, they can move the price, and it depends on the liquidity. And they are so-called, there's a technical term, which is the marginal seller or marginal buyer. In the market, in the secondary market, or maybe even in the primary market, when you don't need to buy the whole company or buy the whole unit of something, of a stuff. Let's say you don't need to buy the existing circulating, the existing Bitcoin in circulation, or you don't need to buy the Tesla stock in circulation. Yeah, you are not buying the 100% companies. This means and the ticker can be traded in markets, right?
Yeah.
So that means this type of market is formed by marginal buyer and seller, which means the price is determined by the marginal seller and buyer. What's the implication here? Okay, but before that, do you really understand the statements?
Okay. Maybe I need to make sure marginal seller and marginal buyer. Are you referring to those who just come in?
Yeah, right. Who just come in or who want to come out, who want to go out, seller.
Okay. Yeah. Okay. So yeah, I know the term marginal, but when link it together, you say is depending on them.
Yeah, the market price is depending on them. So what's the implication here? What is the insight you can get from it? Okay, now give you one example. How about one day you wake up, you found that your stock dropped 90%.
Okay.
What will you feel?
Yeah, of course, feel bad.
Then what will you do? Maybe sell your stock?
Maybe sell, maybe still keep because dropped so many already.
Okay, but why you feel so bad?
Okay. Because if it drops 90%, mostly we spend more than that to buy that in the past, so we lose money.
But
Yeah.
who make the cost? I mean, who make the drop? Who caused it?
The marginal seller.
Yeah, marginal seller. Then how to move your stock from 10% of original market capitalization back to the original market capitalization? Who you need?
We need marginal buyer to push that up again.
Yeah. So what's the implication is when there's a panic, okay, and people rush and sell the ticker and to get money from it. Why they need to get money? You have many reasons. For example, it also can be the game theory because they think people will want to sell, though they try to front run them.
Yeah.
But more and more people doing this, they kind of like become a domino effect and then create a drop.
Yeah.
And it could be because of our bond market, because of our debt. We have so huge of debt. When there's a panic, because our current fiat system based on trust, when people don't trust you, your collateral, they don't trust your collateral, they ask you to top up margin. Because you see your collateral value can drop very easily. It affected by the margin of seller. And the second is when people don't trust you, they require some real money, or they require some quote unquote the asset they think worth the value. Maybe as a collateral to allow you to borrow money, or maybe you want to do some trade. You are the company. You want to do some international trade. You want to import something, or you are the exporter. You want to export something, and your bank. You ask your bank to help you do the letter of credit LOC, which means because you are buying some product from outside the country, but you have no idea whether the country whether the foreign country will cheat you or not. Because once you pay the money, if they don't ship you the goods, then you suffer loss. Once they ship out the goods, once you receive the goods and you don't pay the money, and they suffer the loss.
Yeah.
both party cannot trust each other, and they rely on the bank, which is the financial intermediaries. But our money is not just we pay to bank. The bank in domestic country can directly pay the money to a foreign bank, which is the direct financial intermediaries of the foreign company that you trade with, right? The money isn't just flow to the country. Central bank control the banks, control your banks, and when your commercial bank take your trade, they take your money, and then they submit to central bank, and central bank verified, yeah. Or maybe the commercial bank can do it by their own. If the commercial bank have a huge network and your commercial bank is well reputed, and also the foreign bank of your supplier is also well reputed. Maybe they have some direct network they can link. Yeah. And there's some collateral held by your commercial bank, which is the collateral put by the foreign bank, and each other can do each other bank can do the same thing. So they don't need the. It's kind of like because you hold there's a collateral here, and it can use the collateral to facilitate the trade. Yeah. But even though it's the case, it will also be difficult because the value of collateral can drop very easily.
Yeah.
And you don't know how much the collateral you can materialize. And if you approve the trade, so that means maybe you submit to central bank, or maybe you're using the SWIFT network. Yeah. Using a SWIFT network, and you really submit to the central bank, something like that, and then really transfer the money, which is irreversible. And then you're not sure the value of collateral really would that. Then you will stop processing the payments. Yeah. You will stop processing a payment, and then the trade cannot be done. Or maybe you just don't trust the money. The money comes from the buyer. Yeah. So it could be many of the reasons which make the trust. Because this is a trust system, and something happened and it makes the system cannot work because nobody trusts each other.
Yep.
And because our collateral is based on the price, is based on the market capitalization, so a lot of things stop functioning. You couldn't confirm what is the lowest point of the price, so that you cannot confirm how much the value of the collateral. And when you need to top up money, so that you need to finance money from elsewhere in order to top up your collateral, so you can facilitate the trade, you can do something, or you are the investor. Yeah, the bank suddenly require you to top up your collateral, to top up some money. Then you have to sell something. You have to sell something in order to top up. or maybe you have to sell some of your collateral, some of your stock, in order to solve the margin problem. So the bank will not force sell your stock. Or even though you do nothing, the bank will still force sell your stock, and it will lead to the market crash. So when there's a panic comes, and we call liquidity crisis, which is actually the quote unquote the real money isn't that much, and people want to convert all of these things back to the real money and save it in their bank account, the real bank account, or maybe you want to take it out and really can see it, really can hold it, the real cash. And because our system is based on the trust, is kind of like facilitated by debt, which we discussed in previous topic. And when the bank lend out money, it just create money. Yeah. So this means people want to see the real cash. Because, okay, why you don't want to hold the assets? Because your assets is a liability of others. Right? For example, your stock is a liability of the company. Not the stock. I mean, maybe the bonds, okay, or maybe the commercial paper, yeah, of this thing. Your asset is the liability of others, and also even though you hold the stock is a company stock, and you're not sure whether they will face a liquidity problem and suddenly go bankrupt, and then your assets just turn to zero, just worth maybe from 1 million suddenly just become zero because the company face a problem to continue to operate, and it cannot finance by itself. So when it go bankrupt, your asset turns zero, your liability also turns zero. So we want to convert all kind of assets back to the real money. Yeah. They cannot be rehypothesis, which is kind of like the bank can create out of thin air, which is not based by debt. Yeah. It cannot be reproduced. Yeah, in short, it's hard money. It's a real hard money. For example, the gold. But you're also not sure when you buy the gold, but the gold still haven't shipped out. Because when you hold the real physical gold, then this is the real asset. But if you buy the paper gold, yeah, the paper gold is held by another entity. What if the entity go bankrupt? And then this is they just don't need to pay you the gold because they have no enough gold. Yeah.
Yeah.
So everyone trying to convert their assets back to the real cash. Yeah. And even though you save your cash into the bank can go bankrupt, right? And you may think, okay, I can take out all the cash from bank. So this is a bank panic, right? And it increase the chances. It contribute to the bank bankruptcy.
Yeah.
And then when you take out the money, this is still obligation of central bank, of the government. And you can take out your paper money. This is something like it may you're right, the term is kind of like this is a liability of your central bank. Yeah. So that's what does it mean if your government, if your country become insolvent, the value of your money just goes zero. Because this is your asset and this is their liability. But normally it will not directly go zero, but just because everyone don't recognize the value. And you cannot use the money to buy foods. You need to pay a higher price, a much higher price, maybe a factor of 10s. So what does it mean? This is hyperinflation.
Yeah.
People lose the trust of the currency. So by linking everything together, you get a very big picture, and you know that central bank had to save the markets, cannot allow the very, very serious financial crisis. And it depends on the debt, the level of the debt. Yeah. And this is how our equity, our bonds market functions. So it is just inevitable. It is a fundamental of the macro. Just derive from the question, a very simple question: where the money goes in a recession. So you can see the market is kind of like depend on the expectation, right? And this is the first thing. The everything I say just now is the first implication. And the second implication is that means you need to try to buy the real assets. Yeah. And but how real it could be. And you need to buy the company which can go through the recession. We can go through the liquidity crisis. So they don't have the liquidity risk. So they will not suddenly go bankrupt just because they cannot finance themselves. Yeah, so that's because of the first implication, you know that central bank necessarily need to save the market. So you will be safe. It's kind of like too big to fail. You will be safe as long as you are not buying the worst. You are not buying the company who are using the highest leverage. But you want to buy the company who you utilize the leverage. At what point you have to judge by your own. Because they use the leverage, they can outperform their competitors. The competitor who didn't use the leverage, they will just lose the market. They will just lose the competition. And they will just go away when the market is still functioning well. They will not have the chance to go through a recession. They just die very quickly. But you cannot buy the company who use too much leverage because they also will die. They cannot go through the whole recession. And when people know this, when the panic comes, or when they foresee a panic, when they foresee a recession, when they foresee a financial crisis, when there's uncertainty comes, maybe it's due to the war, the potential of the pandemic get worse, they will sell this kind of stock. They will buy the called the value stock, or the stock that have less like liquidity risk. They try to find a safe havens. So you can see when the macro environment is not good, growth stocks tend to perform very, very bad compared to the value stock. Yeah. So this is the second implication. And the third implication is the price. The price, the drop of the price is caused by the marginal seller. So you shouldn't focus too much on the market price, because it could be just temporarily. Yeah. And the marginal seller doesn't mean they sell a lot. No, maybe they just sell little, but they can move the price, maybe move the Bitcoin price from 39,000 to maybe 5,000. They can move the price. And you suddenly say, oh wow, your Bitcoin price turns from 39,000 to 5,000. Something happens. I have to sell. And after you sell, it rises back from 5,000 back to 39,000. So this is the implication. You shouldn't focus too much on the market price. You need to look at the fundamental. You need to focus on your understanding. Is there any changes? What is the change of the fundamental? If there's a maybe a technical flaw that cannot be solved, then maybe you need to sell. But if this is something that will not change the fundamental, especially for long-term fundamental prospect, and then there's no reason for you to sell. Yeah.
Also the same for the opposite, right? When you see the price go up, but you doesn't see like the fundamental.
Yeah, right.
That worth that.
Yeah, right. Yeah. Okay. So yeah, there is almost everything I want to mention for this conversation.
Okay. So go back to the topic. So what kind of answer will be like where the money goes? Is it goes to the liquidity? Can we say that, or what?
This is expectation. You can say, quote unquote, the money doesn't exist, or this is just in our mind we perceive the value, so it got a value. You can say this something like a shared belief. Yeah. You think everyone think Tesla worth $3,000. So it traded at $3,000. But more and more people think Tesla stock don't worth $3,000. It should worth $500. And they take action. They really take the real action. And it will move the price from 3,000 to 500. And George Soros, which is one of the greatest investor, he has one terms which is called the reflexivity. In Chinese, translated in Chinese is called the 反身性. And I've wrote an article for it on my blog. And what does it mean? Reflexivity is when the price goes up, it increases people confidence, it increases people belief, and then they buy more, and then the company get popularized, get the attention. So maybe it gets more finance, maybe more easier to do marketing. It could be many things. So that the media focus more about the company because the media know people like this company. People like to get the news from this company. Yeah. So when the price goes up, what kind of news can attract people look at? Is it bad news or is it good news? Of course, it's a good news. But when the price goes down, what kind of news can let people see? I mean, people like to see. People like to see the bad news because they want to know why the price goes down. Yeah. So when the price goes up and the media try to find out some good news, there's a lot of bad news. There's also a lot of good news. But at this point, media try to find out the good news, and the good news published, people feel more confident because they think the price goes up is because of the good news, and there's some insider trading, and move the price goes up before the news published. And it becomes a loop, a feedback loop, until a point some investors start to sell. They think the price is too high, and then it leads to the negative reflexivity. Yeah. And also, I think you remind me one of the things, which is you can link all these things together: money, wealth, asset, and also the purchasing power. Yeah. You want to see how much money you have? Yeah. And you think you have a lot of money, you are rich, but you still need to look at how much things you can buy from your money, which you need to take the inflation into consideration, which in turn you try to find out the real purchasing power of you. For example, maybe you think that, okay, I save a lot of money, and last year my saving is only 5,000. Now my saving, let's say, is 10K. Oh, my saving increased 5,000, increased 100%. So great. Yeah, great. But if you look at the price, if you see all the price go double or triple, you actually get worse. Yeah. And also maybe, but there's a tricky point here. Not everything will goes up so much. Some of things will even go down the price because the variable cost, because the big cost, the production of the product, the cost component of the production of the product is high fixed cost and low variable cost, or low marginal cost. Just like, for example, the digital product, they can produce a lot because they incur the big cost. Yeah, they can sell you very cheap. They still can, and also because of the competition, it will drive the price cheap. But what if, like, you are buying a product that have high variable cost? Maybe you go to a retail shop, they need to pay the rental. Yeah, of course, rental is fixed cost. But the fixed cost can increase. Yeah, even though the fixed cost even increase, okay, let's say the rental cost is fixed, but they need to buy the product in order to sell you, and the product price rise. They have to raise the price to cover.
Yeah, maybe the material cost increase.
Transportation cost of this, production cost, labor cost. Yeah, and also, so some of the goods, the price will goes up very much. But in the normal situation, we will not see the price of consumer goods go up very, very significant, like we experience today, or in the recent 1 years. This is abnormal situation, really, really abnormal. You know something have changed. The fundamental of the macro have changed. But what goes up? The scarce asset goes up. The stock goes up. The property, the real estate goes up. The bond price goes up. Yeah, cryptos definitely goes up. Yeah, and every kind of all kind of commodities, they can go up, they can go down. It depends on the supply side. Yeah, but this is very hard to say. because you see gold, the recent 10 years performance is actually not good. Yeah. So, but in an abnormal situation, this kind of real asset can really hedge the inflation. But how much it can hedge is still questionable. Because you see, in this recent 1 year, what is the food price? What is the increment of the food price, and how much living costs have increased? Everything, and then you just look at, if you invest in the gold, how much it can get compensated. Maybe a little bit. Yeah. Maybe you fully cover and still have some profit. But doesn't mean that you can invest in gold forever. And how do you time the market? So in long terms, some people think the gold already dead. Yeah. Because we have Bitcoin already. Yeah. But of course, Bitcoin is still a new tech. Yeah. So this is not so promising for many people. Yeah. But what I want to say is, in normal situation, buy the stock, buy the property. And in abnormal situation, maybe you need to hold the real asset like gold. Silver, not sure, because the producer, I mean the miner, the silver miner can increase the supply very significantly. Yeah, gold, the miner can only do like maybe 2%. So I think it's around 2% per year. So it's still hard money. It's still hard money. Yeah. And when the recession comes, holding real cash is a very, very good way to protect your wealth. Yeah. But in a normal situation, holding cash, just like the Ray Dalio say, bond and cash is trust. Yeah.
Yeah.
And how about bond? Yeah, bonds is kind of like, is in a very, very weird situation, because the price is already so high and then the yield is so low already, and you are not going to buy the bonds at a price, at a high level price. You're not going to buy them, and when the price goes down, so the yield goes up, this means something bad happens. The crisis comes, and the central bank want to save the economy, want to save the market, and then they will do more QE, print more money, and then the bond price it just goes up again. So it's kind of like there's no situation you should hold bonds for long terms. Yeah, beside of kind of like short term trading. And also for individual, it's very difficult to buy bonds. Yeah. And what is the purchasing power implication here? You need to balance the risk. You need to see longer terms. And the market can go down a lot, but if your purchasing power still hold, then it really don't matter much. Yeah. Yeah, but of course you may think, okay, I lose some opportunity, because if I hold the cash, now I can buy more. I will have I will have greater purchasing power. Yeah, you can think like that, but it leads to another question. You need to really time the market. And then the second is when you think you have quite a lot of money.
Yeah.
Think, okay, your saving keep increasing, your income keep increasing, of course, but your cost also keep increasing. But still, there's a net benefit, which is your saving increase. But then you look at your purchasing power, it actually decreasing, so it doesn't make sense. Something wrong. And then the biggest reason is you didn't do investments, so that your purchasing power keep decreasing. Because in normal situations, real assets, scarce assets goes up, but not consumer assets. When consumer goods goes up also, you know something wrong. And even though you don't do investment, you also will be worse off. Yeah. So this is also linked to one of the conclusion why you have to do investment. And also go back to purchasing power. And when your saving goes up, your purchasing power goes down. And then okay, first is something wrong. There's something wrong. You need to find out the reason. And then the second is I suddenly forget what I want to say. Let me think for a while. Yeah, I think okay. The second thing is okay. The second thing is you okay. The first is you need to look at the longer terms. You need to look at the longer terms, and you cannot just look at for today or maybe within these 6 months or within the 1 year. You need to look at the longer terms, so that you can kind of like figure out whether your long-term purchasing power likely to increase or decrease. And also, and the second part of this is linked to another point, which is the advanced application of the first part. What does purchasing power means? It actually means buy something, but what you want to buy? You actually want to buy back your freedom. You want to buy back your future. You want to buy back your future time. Not buy back. You need to buy your future time. You need to provide for your futures, and it linked to the financial budget topic. So, in personal finance, everything is just the function of cost. So that means what is purchasing power here is actually your cost to maintain your living. Yeah. So this means if you want to look at your purchasing power using a quantitative analysis perspective, you find out how far away you can become financial freedom, and is it become farther? Is it become a farther, or is it become nearer? So that you know that your purchasing power actually increase or decrease. Yeah. So this is the whole point, and this is how look at the purchasing power is more important than look at your money. And because the cost can increase, if the cost increase, what does it mean? It means the inflation increase, and so that means you need more price. So you need more wealth. You need more wealth to get financial freedom. That means your purchasing power reduce. And inflation is so dangerous, which I think I I mentioned it in the past, like around 1% increase of inflation for like around 2,500 to 3,000 monthly expenses will cost you like 130. I think it's around 100 to 130,000 more capital, more initial capital. So that means you need to fund, you need to earn, you need to make 100,000 more or 130,000 more in order to cover the additional 1% inflation.
Yeah, this is estimated as using our age, right? 20 something until.
Yeah, 100. Estimated by our age. The more you expect you will live, and then the inflation effect will getting more serious. And the earlier you going to retire, it will affect you more.
Yeah.
Yeah. Okay. So yeah, there's everything I want to say.
Yeah. Just one more little question. There's some people say economic bubble. So the bubble here, is it similar to just now we say the expectation there?
Yeah,
it's
we
not
can
the
say.
real money there.
But what is real money? You cannot answer the question. There's no real money.
Yeah.
Okay.
Yeah. So that's all.
Okay. Talk to you tomorrow.
Yeah. Talk to you tomorrow. Goodbye.
Goodbye.